As of the current market status on Saturday, April 25, 2026, Navitas Semiconductor Corp. (NVTS) is closed for the weekend, following a highly volatile trading session on Friday, April 24. The stock concluded the week at a closing price of $17.28 per share, marking a significant intraday decline of 6.65%. While a nearly 7% drop in a single day might spook the average retail trader looking at a Fidelity mobile app, the reality behind this movement is far more complex than a simple sell-off. Throughout Friday, the stock saw massive swings, hitting an intraday high of $19.79 before sliding toward a low of $16.90. This price action follows a parabolic run earlier in the week, where the stock surged over 20% in a single session. What we are seeing right now is a classic tug-of-war between high-conviction institutional buyers and short-term profit takers who are nervous about the upcoming earnings call on May 5th. While the market expectation is that Navitas is just another speculative semiconductor play riding the coattails of the AI boom, the reality is that the company is quietly positioning itself as the literal power source for the next generation of data centers. Most investors using online investing platforms see the current $17.28 place point and assume the AI trade is cooling off. However, the insight that many are missing is the strategic transformation the company is calling Navitas 2.0. Just a few weeks ago at the Nvidia GTC 2026 event, Navitas showcased a new 800-volt power delivery board. This isn't just a minor upgrade, it's a direct response to the massive power consumption problems facing high-end AI chips. When you look at Nvidia stock or Apple stock, you're looking at the brains of the operation. Navitas provides the muscles, the actual hardware that manages how electricity moves into these chips without melting the motherboard. The general belief is that gallium nitride is only for fast charging your smartphone, but the reality is that Navitas is moving aggressively into the high-power industrial and automotive markets. They are effectively trying to replace every old-school silicon chip in the world with their own GaN and SiC technology. This creates a fascinating tension. The stock is currently priced for perfection, yet the company is still reporting negative earnings per share, with the most recent quarter coming in at a loss of 0.05 cents. Looking at the volume, over 46 million shares changed hands in the last session, which is significantly higher than the daily average. This suggests that the smart money is actively repositioning. If you're using Interactive Brokers or a Fidelity trading platform, you've likely noticed the increased institutional activity in the mid-cap semiconductor space. Small-cap and mid-cap tech stocks often get crushed during periods of high interest rates, but Navitas has managed to decouple from that trend recently. The momentum is being driven by the realization that as AI models get larger, the power grid and the internal power systems of data centers literally cannot keep up. Navitas is stepping into that gap. We've seen similar patterns in Tesla stock during its early growth phases, a company that loses money on paper but is so fundamentally necessary to a shifting industry that the market ignores the current PE ratio. Speaking of holdings, I want to hear from you. Comment below how many shares of NVTS you currently hold, or if you're waiting for a dip back to the $15 range before entering. To understand why the stock is moving this way, we have to look at the underlying business model. Navitas doesn't just sell chips, they sell power ICs, or integrated circuits. Legacy silicon chips are slow and waste a lot of energy as heat. Gallium nitride and silicon carbide, SiC, are what we call wide bandgap materials. They can handle much higher voltages and switch at much faster speeds while staying cool. For a data center operator, this means they can pack more servers into the same room because they don't need as much cooling equipment. This is the reality that is currently fighting the expectation of a simple stock correction. The company has been on an acquisition spree, picking up firms like GaN SiC to bolster its high-power portfolio. This allowed them to move beyond just mobile chargers and into electric vehicle onboard chargers and solar inverters. When you use self-investing tools or a Robinhood app, it's easy to get lost in the daily percentage changes, but the institutional shift into these specialized materials is a multi-year trend that is only just beginning to reflect in the revenue line. Historically, Navitas has been a bit of a show-me story. They went public via a SPAC merger, and like many companies from that era, the stock initially struggled as investors demanded real profits. However, 2026 has been a turning point. The appointment of Tanya Stevens as CFO and the addition of former Broadcom executives to the board signals that the company is maturing. They are moving away from the startup phase and into the industrial scaling phase. This transition is usually where the most significant stock gains or losses occur. The risk here is execution. Navitas has roughly 12 to 18 months to turn its partnership with companies like Nvidia into massive shipping revenue. If they miss that window, the current valuation, which gives them a market cap of nearly $4 billion despite negative earnings, will evaporate. This is why the technical levels are so important right now. The $17.28 close is sitting right on a support line that is held for most of April. If it breaks, we could see a slide toward the 50-day moving average. For those looking for investment help or exploring investing sites, it's important to compare Navitas to its peers. While it doesn't have the massive balance sheet of an Infineon or an ON Semiconductor, it has the agility of a pure-play GaN company. Unlike the diversified giants, every dollar Navitas spends is focused on the next generation of power. This makes them a prime acquisition target, but also a high-risk individual brokerage play. If you're using a SoFi Robo-Advisor or Schwab Intelligent Portfolios, you likely have exposure to the broader semiconductor sector, but picking an individual name like NVTS requires a different level of conviction. The sector momentum is currently in a cooling-off period after the massive AI-driven rally of early 2026, and Navitas is caught in that macroeconomic pressure. High-growth tech is sensitive to every word from the Federal Reserve, and with the next earnings report just days away, the tension I mentioned earlier is at an all-time high. The upcoming catalyst on May 5th cannot be overstated. Wall Street is expecting another 0.05 cents loss per share, but the actual number matters less than the guidance. Analysts are looking for proof that the 800-volt power delivery boards are moving from the demo phase at trade shows to the purchase order phase with major cloud service providers. If CEO Chris Alexandre can point to a backlog of orders for the second half of 2026, the current $17.28 price point will look like a bargain. If the guidance is weak, the stock could easily give back its April gains. This is the quintessential expectation versus reality setup. The market expects a slow, steady path to profitability, but the reality of the AI infrastructure build-out is that it's happening at breakneck speed. Navitas is essentially a leveraged bet on the physical infrastructure of the internet. As we look toward the end of 2026 and into 2027, the future outlook for Navitas depends on its ability to dominate the middle of the power market, applications that are too powerful for old silicon, but don't quite need the extreme heavy-duty capacity of industrial-grade CIC. This sweet spot includes everything from home energy storage systems to AI-enabled laptops. The competition is fierce, with Fidelity Investments and other major funds shifting capital toward larger, more stable players like Marvell or Analog Devices. Yet the pure-play nature of Navitas gives it a scarcity value that larger conglomerates lack. If you are investing online with a long-term horizon, the volatility we saw on Friday is just noise. But for the active trader using a Robinhood trading account, that $2.89 swing from high to low is a clear signal that the market is still undecided on what the true value of this technology really is. In summary, the contrast between the expectation of a simple semiconductor correction and the reality of a fundamental shift in power electronics is what makes Navitas one of the most interesting stocks to watch right now. We started the week with optimism and ended with a sharp 6.65% decline to $17.28, leaving the stock in a precarious but potentially lucrative position. The company has successfully moved from being a mobile charger chip maker to a critical partner in the AI data center space, but the financial statements haven't quite caught up to the technological achievements yet. The tension between its $4 billion market cap and its current lack of profitability is the central theme that will drive the stock for the remainder of the year. Whether you are using Fidelity Brokerage, SoFi Invest, or Interactive Brokers, the key is to look past the intraday fluctuations and focus on the adoption of GaN and SiC technology. The reality is that the world is moving toward higher efficiency, and Navitas owns the patents and the partnerships to lead that move. However, the expectation of immediate returns is a dangerous game in a market this volatile. Keep a close eye on the May 5th earnings call. That will be the moment when the narrative either solidifies or falls apart. Regardless of the short-term price action, the depth of the technological shift Navitas is leading cannot be ignored by anyone serious about the future of the semiconductor industry. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.